Good afternoon, everybody. Stan and Jack here, and we're doing a webinar on a trading system using Elliott Wave. And before we get started, just our normal disclaimer. We do everything on the Art of Chart for educational purposes for traders. We share technical analysis. We share how to do technical analysis. We share how to trade, but we don't issue trading signals. So just to make sure everybody's aware of that. And so we hope you get something from the webinar. That's, of course, why we're doing it. And you'll notice a questions tab in the GoToMeeting or GoToWebinar control panel. Please key in questions. If you have questions about Elliott, we're happy to answer them. So I have an agenda, and I already have a question about, can you show us coffee and do some Elliott on coffee? And yes, I can, David. We will get to that at some point. I do have an agenda, Jack, which I'll throw up here briefly. And all I'm going to do here, and by the way, pitch in anytime you want with any of this. And I wanted to kind of walk us through basically 7 points. Well, first of all, what is Elliott Wave? But second of all, what is non-traditional Elliott Wave? And I use a non-traditional approach, which is a 3-wave approach versus a 5-wave approach. So I actually want to start with that, explain that, give some examples of that, and then actually walk through different patterns and trades using Elliott Wave and show you the trading system. Not only the trading system in terms of where do you enter and where do you exit, but also how do you manage trades? How do you leg in and leg out of trades? And I think I repeated myself here on these 2 points, but 5 points really: managing entries and legging in and out of trades. I think that is a part of a trading system. And also, how do you manage risk? Okay, in terms of how much risk do you put on a trade? Which aspects of Elliott do you not trade? Like, for example, triangles are kind of dicey. So if you're trying to trade a triangle, you're adding risk to your trading. If you're trying to trade a 5th wave, you're adding risk to your trading. Where do you want to trade? The ideal trade is to capture the C leg of a trade, or to capture the 3rd wave of a trade, and to be picky about your entries. Okay, so Elliott Wave isn't necessarily about giving you 3 or 4 different entry points for an impulse. It's like you have to really look at the structure of the market and find out, okay, so where is the lower risk entry? Those are the ones you want, obviously. Okay, so we'll get into a conversation about this, but I was thinking this is a good place to start, Jack. You want to add something to this, or do you want to change a part of the agenda? Does it make sense?
No, I'm quite happy with that. My main contribution is going to be when we're talking about triangles, diagonals, and so on, in terms of the pattern structures in section 4.
Yep. Okay, great. I think we'll be getting to that pretty quick. I'm going to start with just real basic. A picture. Pictures are worth 1,000 words. We're going to start with this comparison picture. Now, many of you have seen me do counts in the daily update that we do. So we do a 5-day-a-week daily video update, and I'm constantly talking about swings and counts and so on and so forth. And I want to show you where I get some of the methods that I use here, and I'm going to show you in a minute why I use a 3-wave version of Elliott. This is your traditional version of Elliott, and T.S. Eliot was a gentleman who actually is a finance guy who noticed, many years ago, a pattern in the market in terms of, you get started in a turn. If there was a downturn, you get started in a turn slowly, usually a 50% backtest, and then you get an impulsive wave, okay? Then, of course, you get this divergence wave here. Typically on RSI, your 5th wave is a divergence wave. I'll show you what that means on RSI in a moment, but this is the traditional setup, and there's certain assumptions that are made here, okay? Like, for example, the 3rd wave is typically a 1.618 Fibonacci off of wave 1 and 2, usually 1.618. Usually from the origin to wave 3 to wave 4, wave 5 is typically a 0.618, okay? And there's also, a 5 = 1, which is the wave 1 is equal to wave 5. So, I'm very, very familiar with traditional Elliott, and I used to trade it a lot, but you know what? I discovered, and I read a book, and it really changed my whole headset, and this was many years ago, looking at Elliott in 3s, okay? And if you look at 3s in terms of 3-wave moves, they're everywhere in the market. And there's a way of seeing them and a way of actually identifying them that I think work very, very well. And this is basically, 3 waves up for 1, 3 waves down for 2. 3 waves for a 3, 3 down for a 4, 3 up for a 5. And by the way, the 5th wave is still the divergence wave, okay, using RSI. The 3rd wave is always the strongest wave. There are exceptions to that, of course. A contracting diagonal, the 3rd wave, is not the longest wave or the strongest wave. It's actually shorter than wave 1, but that's a specific pattern that we'll probably wind up talking about later. So that's the comparison between the two. I'm going to show you how this works in a moment in a real life chart. Okay, I guess what I wanted to share as well with that is, where is it? Failing fifth waves, okay? Now, the number of traditional Elliott folks, and this is the thing that convinced me to switch over, okay? I want you to look at the count in black, okay? And I want you to look at the count in blue. Black is the traditional version of Elliott. So you have a 1, 2, and then you have nested 1, 2s, okay? Then you have a 3, 4, 5, a 3, 4, 5, which ends up being a 3 and a 4. Basically what I'm trying to share with you here is you wind up with a 5th wave that is a failed 5th. It runs short. And this gets talked about a lot. Oh, this is actually wave 5, but it's shorter than this wave. It's a failed 5th. Now, in traditional Elliott, that's true. But if you look at a 3-wave version, it's not 1, 2, it's AB. Okay, your 1 is here. Here's your 2. Here's an AB, here's your 3, here's your 4, here's your AB, and there's your 5, and you're done. Okay, so it's a heck of a lot simpler, folks. And you know what? The thing about me and trading is this: I want something simple that works. Okay, and I think traders make things hard for themselves. And I remember the days where I used to have 15 indicators on my charts, and I just basically use one. Well, I use 1 or 2, okay? I don't use a lot, and I use a lot of Fibonacci work. I do a lot of work with price and time cycles, and I do a lot of work with Elliott to help me understand structure. I use Elliott and patterns and floor ceilings to understand market dynamics and patterns and correlations across the market as well. So, you know, I try to keep things simple because guess what? It takes a lot of time to do this work. I mean, you know, the amount of time I spend looking at 20 to 30 instruments a week, it's a significant amount of time. So, you know, I don't want to spend my evening.
It takes a lot of time.
It takes Jack and I, trust me, we know. I mean, Jack was up until what time last night, Jack, doing charts? I was up until like 11 p.m.
I don't have to.
You were up later than me. Okay, so you know, we put a lot of hours in the charts, and I don't have the time to do 1, 2. Now, is this a 1? Or is this a 2? Or you know, a 1, 2, 1, 2, 1, 2. The number of iterations that you have to go through to figure out, is this a 1, 2, 1, 2, 1, 2? This is a 3, 4, 3, 4, 3, 4. You know, it's like, it's maddening for me. Okay, so I'm not trying to look. First of all, I don't want to discount anyone's approach to the market. There are 500 different ways to do something, right? So if you're a traditional Elliott person and it works for you, bravo, good for you. Okay, wonderful. If you have never seen Elliott before, you got 2 options, and try them both, and whichever one works for you, bravo, great. I think the idea of trading is you got to find something that fits your style, that helps you see the market, that helps you find entries, that helps you find resistance, and helps you make good decisions. So that's the idea of using anything like this. Any technique, I don't care what it is, it's all about support and resistance. I mean, that's what trading comes down to, is where is support, where is resistance, where do I put on risk, where do I take off risk? And, you know, that's my basic philosophy. So boiling all of this down, it has to do with support and resistance, and where is it, and how do I see it, and what pattern am I in, and what are the odds based on the pattern that I'm in, and all that kind of stuff. So anyway, so that's my basic intro.
Just as a very quick aside,
yeah,
this point about whether it works, the reality is this absolutely has to be the essence of your TA. If it works, it's worth repeating and doing more of it. If it doesn't work, you discard it and you move on to something else.
I fully agree.
Doesn't matter. Yeah, I mean, because the reality is you'll come across a lot of stuff that works and a lot of stuff that doesn't work, and you just got to discard what doesn't work and just run with what does work. That is the essence of practical TA.
That's it. Right on target. Absolutely agree. And so, you know, don't swallow something I do. Something I do works for me, but you may find something that works better for you, and that's what you should go with, of course. Okay, so with that said, let's look at the EMini. Okay, and let's talk about trading. So I'm going to start with just what we see right in front of us. This is a 15-minute chart, and if you want to learn Elliott, I would probably do 15-minute charts, but also hourly charts, because you will be able to, let's put it this way, you get to a 5-minute chart and you're doing Elliott, it's a little bit difficult, okay? But I want to talk to you about trading and trading systems and three-wave moves. Now let's take a look at, first of all, what direction the trend is, okay? Now I have a little marker on my chart. It says down, okay? And so we are in a downward trend at this moment in time, and we turned that around. I think it was way back here, okay? We called this turn here, and we were a little late, actually, because we had called this turn previously. But anyway, bottom line is lower high here, we said get short, and you know, we've been basically shorting rallies ever since then. Now, what I want to say is let's just take a look at the current formation, and this looks really jagged and spiky, and what the heck is this thing that we're looking at, right? It looks like it would be difficult to trade, but let me help you see what's there from an Elliott perspective, okay? So I'm going to start here at this turn, which is the W, okay? And I can show you on the way down how I got to the W in a moment, but and I use WX, Y, X, Z for an impulse in the direction of the trend, whether it's up or down, okay? Instead of 1, 2, 3, 4, 5. That's just how I do what I do, and I prefer the letters over the numbers because in my head, at least, the numbers have specific meaning in terms of Fibonacci sequences, okay? And I have to forget what I have up here in numbers, okay? Because it's like buried in my brain, and I have to use letters because it's a completely different way of thinking about it, okay? So anyway, that's me, and that's a hang-up I have, which is why I use letters. So I have like a fresh palette, if you will, in terms of how I see things. So, you know, from here, you can see here, I hope, the yellow box here, the yellow box here, the yellow box is up here, a three-wave move, okay? So from here, you know, I'm using Fibonacci sequences here. There's your A, right? And let me find it. There it is. There's your B, okay? An ABC type sequence, and you can see where the 100% fib is. So typically what I'm looking for is something between the 100% fib and the 1.236. Okay, so this was 77s to 83s, and let me get rid of the line there. And so, you know, it's as simple as that on a backtest. This is a backtest into an X wave. Now, an X wave is nothing but a connector wave. Now, what the X wave means is that the next sequence lower is actually independent of everything else that happened before it. Can I connect W and X and extend it down to 2003? You see my next fib here? My next Fibonacci here is 2003, a 100% fib, okay? That's my target of this move, okay? Now, all this is a three-wave move. I think from a pattern perspective, I think, Jack, that would be called, well, first of all, it's a back test, but there's a channel there. If I were looking at this from a pattern perspective, right? Here's your,
yep.
Here's your channel, okay? And so duplicate, okay? So, you know, a three-wave move is very often a channel, or it sometimes is a wedge. This is actually a bit of a wedge. Okay, and even sometimes it's a megaphone, but a three-wave move often takes one of those three shapes. Okay, and by
essentially all three forms are types of channel.
That's right.
Yeah, we've got expanding, contracting, and parallel.
Right. And just to share with you, like this move here is now consider for a moment that the X again is a connector. Okay, so if I look at this and I look at this as a three-wave move, where's my fib? See my fib right here at 2034? It's a three-wave move. I'm looking for the 100% fib, okay? When we get down here, what am I looking for is a back test. Now, this back test is a flat. Let me just walk you through what a flat is in a moment, and I'm going to just show you different formations here and kind of pick this chart apart. Especially this next downtrend here is very interesting. I'll show it to you in a minute here, but let me get up my flat. Okay, this is a flat. Okay, from the origin you have an A and then a B higher than the origin and then a 5-wave move. Okay, or a flat could be an A, a B equal to the origin, and a 5-wave move. Now, it usually takes one or the other in terms of its shape, okay? And we have flats all over this market right now. So if you are a student of Elliott, you can pick up where turns are. Now, let me show you a couple of examples of what a flat is. And I also want to talk about how to trade this, okay? So let me go back to this for a moment. So let's say I was bright enough to say, you know, 34s are a possible trade, okay? So what do? I wait for 34s. Now, do I put it on here at 30.50? We go through our area and we hit 30.50, okay? Do I put it on there? No. I wait for the lower high. And why do I wait for the lower high? To confirm that my TA is right, okay? Do I know that it's right? No, I don't. Do I put on something at 30s? No. Why? You know, there's no confirmation that this is the low or that this is a turn. I'm looking for something to give me an edge, right? Now, look at RSI here for a moment. This is what gives me an edge, okay? Right here. When I see, sorry, looking at the wrong thing. When I see this, I see a lower low with divergence on RSI, okay? See that divergence right there? We have a higher low in RSI and a lower low in price. That gives me a lot of confidence. It tells me that this is the divergence wave, okay? So if you will, from the top, right, your WX, YX, Z, okay? And I'm looking for the 100% fib from the X. Here's your 3-wave move to 34s. We go through the area. And by the way, I just want to say something about day trading versus swing trading, okay? You know, if I'm day trading a 3-minute chart, okay, levels are important by 2 ticks. Okay, if I'm looking at an hourly chart, then I'm looking at areas. So, you know, swing traders look at areas, day traders look at levels, okay? There's nothing wrong with either. It depends upon your style of trading, okay? So I'm looking at 34s, and I'm giving it plus or minus, you know, whatever, 4 handles or so. So as far as I'm concerned, this penetration, especially with this overnight open, I mean, that's what that was. That was a Sunday open that just got hammered, right? And it bounced, okay? So bottom line is I look for the lower high and I look for divergence. So, you know, if we have divergence and then I see a higher low, that's your entry, okay? So let's say I got smart enough that I put some on here, and let's say I only put on half a position because I was like, well, we could go lower, and my trade plan is, you know, 100% fib, we're going to put some on, and then we're going to wait to see if it goes to the 1.236. Remember I said usually it's between the 100% and 1.236 fibs, right? So what do? I put on a leg. I put on a half a position or a third of a position or 2/3 of a position, whatever. Now, where do I take off my first third, okay? This is a bit of a debate among traders, and this is just how I do it, and it's very simple. I look at the last swing. And if I'm feeling rather conservative, I look at this swing right here. This is the last swing. And I say, okay, where's the 50% back? Right there is 50% back. So right there on that first impulse, I'm out a third of my entire position. And I'm holding on to 2/3, okay? What do I do with my second position? I wait for a 3-wave move up. I would wait for 3 waves up. Right here, I would be out of my second third. And what am I doing? After I take off my first third, what do? I put my stop to even. So if I entered at this lower high here at 34s, for example, okay, I'm out at 45s. I'm plus 10 on 1/3 of my position, and I put my stop to even, and I let the trade go, okay? 3 up would be right here. I entered at 34s. What's my level now? I'm at 55s. That's 20 handles, okay? Now I'm plus 20. I take off my second third, and I let my last third play. And what do I do with my last third? I let it go, okay? And, you know, you could easily interpret this right here as the next 3-wave move up. You could take off your last third there and be perfectly fine and happy with the trade. I would be. Guess what? From 34 to here, what am I? I'm plus whatever I'm at. I'm at least plus 30, okay, at that point in time. And by the way, do I need to be in every swing? Do I need to capture every move? Absolutely not. If I capture 60% of a swing, if I capture 60% of this, I am just really, really happy, guys. And guess what? I'll watch that last leg go up, and I will wait for 77s with a lot of patience because I already have 30 handles in my pocket. So, you know, I would rather get in a swing and let it play and leg out and leg out and leg out and not capture it all than try to figure out in the middle of a trend, The thing that kills day traders, in my opinion, is in the middle of the trend, you're trying to figure out what side of the market to get on. Okay, the best way to trade is to wait for the extremes. You trade the extremes. Okay, you get in at the extreme, which, by the way, is sometimes risky, and you have to manage your risk. But you know, it's a heck of a lot easier to trade by getting into a position and legging out slowly, capture 60% of the move. It's more conservative, and frankly, I have a lot more consistency trying to trade that way rather than trying to capture every move. You know, I think that's a mistake folks make. But anyway, you have anything you want to add there, Jack? I'm just trying to share just a style of trading in terms of legging in and legging out, et cetera.
I mean, I think legging in, legging out, you know, getting your risk out, etc. This is all standard good stuff.
Absolutely.
That everyone should be trying to incorporate into their trading.
Yep, agree. So, so this is the basics of the trading system. So, and by the way, if you have a little bit more confidence, okay, if you're really confident, it's like, hey, 5 down at W, okay, I'm expecting a big back test that would back test and retest. And by the way, that was our whole thesis at this point, that we would back test this entire structure, right? Where we would expect the back test to go, usually, is 50% back. So there is your 50% back right here. Okay, and maybe you exited the trade there. It actually went to the 618, which is also common, but typically a back test is going to go into this golden ratio zone, 0.382 to 0.618, right? So if you're 5 down into a W, you're looking for at least a 50% back test, maybe 618. Now there's some rules in Elliott, like a fourth wave is never more than 0.382, and you know a second wave is deeper, it can be 618. Those rules don't really hold up very well in my experience. Okay, so how I look at Elliott is this. I look for the 50 back. Okay, and my basic thesis is this, and I try to keep things simple again. Okay, if I'm trading this and I'm feeling more confident, right? I'm showing you the conservative approach, right? I take my 50%. Hold on, let me do this right. If I'm feeling conservative, right, and I just don't want to take a lot of risk, I take the very previous swing and I take off a third at 50%. I wait for 3 up, I take off a second third, and then my last third, I really don't care what happens, okay, and my stop's at even. If I'm feeling like a little bit more risk, then what I do is I just take the entire 3-wave swing from the X, okay, and I would do this. I would say, where's my 50 back? Okay, my 50 back is here. Okay, that's my first leg up. And by the way, this is typically where you find a lot of resistance in the market. You find it inside the golden ratio zone from the X to the W, or whatever the last swing is, right? You'll find it here. You'll find it here, very, very common. And what do? You take off a third, you put your stop to even, and you wait. You wait for the 3 back to play out. Now look at the 3 back, A, B, C, 3 back, and off it goes. Now where do I take off my second third? Here. If I see a 3 up, I take off my second third, I let my last third play. So it depends how you want to trade the market in terms of what your time frame is, in terms of your risk. But my way of looking at it is 50 back is a key level. I exit at that level, I exit a third at that level, move my stop to even, and depending upon the structure I'm in, I can choose this swing, I can choose this swing. Hell, if I want to, I can even choose the biggest swing, you know, which I never do this, by the way. I never say, oh, I'm waiting for the 50 back all the way up here, okay? That, in my opinion, is leaving too much risk on the table, okay? Now, if I'm trading something into a June low, which I am, I have some options on right now into the June low from a cycle perspective, well, fine, I'll be doing that. But you know, in my week-to-week trading, where I'm holding things for 2 days to as much as 2 weeks, this is how I'm exiting trades using Elliott. Getting into a trade, putting on appropriate risk given the size of my account. Okay, I never like to lose more than 2% of my account in any one trade. Okay, that's just how I manage my account, and I leg out of trades. And I minimize my risk. And I think minimizing your risk is very, very key in whatever trading system you use. And I would encourage you guys, if you don't have a system, use a system. That system I just shared with you has saved my ass. I can't tell you how many times. It really has. Okay, so an example of a flat. Sure, I'd be more than happy to show you an example of a flat. I was just going to go into this sequence here. Okay, now here's a flat. We have a 3 down for a W here to 43s. Now, by the way, very often you don't hit the exact Fibonacci. Here we're off by a couple of handles, okay? So we have a 3 down here into a W, right? Here's an A, here's a B, here's a 1, 2, 3, 4, 5, okay? Perfect flat. Now, where's the 618? And by the way, this is reality, okay? The reality of trading is Fibonacci's are not always precise, but you have to get the sense of the pattern, okay? There's a pattern here, okay? So let me get the fibs right, okay? And by the way, I use fibs to identify patterns. So I'm using fibs to correctly identify patterns. So first of all, there's your A, there's your B. Oops, sorry. Now look where my 618 is. It's right here at 62s. Now the thing about indexes is this. I would say that the ES, the EMini, is not going to be precise when you're looking at flats or when you're looking at any sort of other retracement patterns. You have to see the pattern, and can you go, usually you hit the 618, the 1.618, you hit it pretty clearly in an expanded flat like that, okay? But an expanded flat is nothing but a reversal pattern, okay? So it's an A, B, 1, 2, 3, 4, 5, okay? We were here and we said expect downside or a possible higher high to the trend line. We got the higher high to the trend line, but basically there's your flat. That's an expanded flat. So looking at the flat diagram, and again, what happens very often in trading is you have to learn to see the theory in reality, okay? What I just shared with you was this upside down, okay? It's an expanded flat. Here's your origin, here's your A. The B goes beyond the origin, and then you get a 5-wave move. Now, the way you see 5-wave moves typically in a flat, in a bearish market, these are so common in a bearish market. By the way, here's another one right here, okay? Here's your A. Let me mark it so you can see it. All right, so there's your A, and let me mark it as an A. And this is again why we were so confident about the turn, okay? How you get so confident about turns and where you're going to turn and where support and resistance is, you recognize patterns, okay? So let's get into this a little bit. There's your B, okay? Now, where's the 618? I'm not going to draw the fib, okay? But if I draw the fib, A, B, 5 up for a C, right there it is, right to the 1.618, we said 57.75. What was the high? 57.75 to the tick. Now, by the way, that doesn't happen very often, okay? But when it does, you celebrate and you say, you know, wonderful, this is great. And you just say, okay, count my blessings. It doesn't happen every day, but I'll take it, right? So, you know, we were looking at 53 to 55, and we said, watch for resistance. We got resistance, and boom, okay? Now, what do you do when you have a flat? A flat is always an X wave, and it's a reversal pattern, right? So what are we looking for now? A 3-wave move lower. W, X, 100% fib is 24s. That's what we saw today, okay? So all this is, guys, is you're linking together 3-wave moves off of connector waves. X's are nothing but connectors. That's all they are. So this is a W, X, Y, 3-wave move to 24s. What are we looking for now? A back test. And the question in my mind at this moment, we have a W, X, Y, 3-wave move has completed. This should retrace the entire structure, okay? It should. It doesn't have to, because we're in a fairly bearish structure right now. Now, this is the other thing I think, Jack, you will probably have something to say about this for sure. This is a potential triangle, and I can show you on the NASDAQ composite. We have a beautiful triangle on the NASDAQ, okay? But from the W here, this is an A, this is a B, this is a C, this is a D. You have a flat for an E, and here we are breaking out of a triangle. In typical triangle breakouts, you break out, you make your 3-wave move down to 24s, and then you're going to back test triangle resistance. So we're looking at, and that, by the way, just comes with knowledge of structure and experience, okay? And by the way, the other thing...
And then and only then does the main move begin.
Yeah, right, exactly. So, and see the compression on RSI? This is the other giveaway that we're in a triangle. You get compression, 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 and then you get a thrust out of a triangle. And typically a triangle has this little back test move first. And by the way, look at gold and look at some others. Sometimes you go inside the triangle, okay? So a trip to 53s, very possible, okay? So that's an example of recognizing patterns inside of inside of a structure and then knowing, you know, how to trade it. So, you know, we were short up here because we said, you know, watch this area. And what do? The trading system. I'm just going to go over it again. Here's the previous swing. Okay. So what do? You get out 1/3 right here at 46s. You wait for a 3-wave move down. Okay. You could take it off here if you want, or you could take it off down here. Take off a second third here. Take off your third on the way back. I would say once you cross this area here, which would be 34s. Okay. Giving it a chance, because typically if this were going to fail, it would fail right there at 34s where previous support was. Okay. That's something I look for on backtest. So, so that's kind of the basics of. Could you review the wave numbering scheme W, X, Y, X, Z versus traditional fibs again? Mark, I'm looking for 100% fib moves. Okay, I'm looking for 100% fib moves to 1.236 fib moves. So, like for example, let me just get my cursor here. I'll draw a bigger fib, that way it's easier for everybody to see. But how I would traditionally do this in the evenings over a glass of wine, which is my favorite thing to do at the end of the day, is this. I would be taking, I'll clean this up for you a little bit so you can see it. But what I do is this. I look for the 100% fib and the 1.236, and that's what I'm looking for, okay? And I'm looking for that in 3-wave combinations. Right there's one, right? Here's another 3-wave move. Right there's one. This is actually a 5-wave move simply because it's a flat, right? But it's a 3-wave move, but it's an expanded flat. Here's a WX down to 24s. There's another 3-wave move. And by the way, the W correctly identified and this flat correctly identified gave me the right number, okay? So all I'm doing is stringing together 3-wave moves between 100% and 1.236, and that's what I'm doing. And there are other measurement techniques that I use, like for example, I'll show you this one. I'll do what's known as, a fib expansion, okay? So, and you do this a lot for Gartley's and other types of patterns like this. You see the 19s right here. I have the 1.236 of a bearish move, okay? And that's an area of support. So 19s to 17s right here, or 19s to 18s is an area of support, which I'll be watching for. Will that play out? I don't know. Nobody does, but you know, part of trading is actually watching price and seeing what it does when it reaches certain levels. You know, so I'll be watching that area. That's another way that I measure. Now, traditional Elliott would say that the next move isn't at 2003. The next move is down at 1957. Okay, because the WXY that I look for here in the black W and X goes to 2003. That's 100% fib in my counting scheme, right? So going back to this diagram, right? So you can see 3 waves, 3 waves, 3 waves, 3 waves, 3 waves, versus in a traditional Elliott sequence, your 1 and 2 leads to a 1.6183, and typically then it leads to a 0.618 origin 3, 4, 5. Okay, so it's a different measuring scheme, and frankly, this type of impulse, and the reason I switched over to a 3-wave sequence, I'm going to tell you right now, the market is not the same as it used to be. Okay, this 3-wave sequence, and how can I say this? I mean, just look at this chart. Okay, just look at this chart. Just look at where the yellow boxes are. Okay, I'm not trying to brag or anything like that, but if it wasn't for me having the 3-wave sequence and I'm trying to use a 5-wave sequence inside of this, I'd be absolutely lost. If I'm looking for a 1.618 fib here anywhere, I'd be absolutely lost. So all I'm going to tell you is this: the market, in my opinion, in the last decade has changed, okay? And I've been trading since 1999, and it used to be years ago, especially in 9 and 10, at the beginning of the bull market, yeah, boy, I tell you what, the impulses we had were just enormous, right? But and the market we're in now, I have to be honest with you, the 3-wave sequence works for me, and the 100% fib works for me, and it's simple, it's easy, it's not complicated. The trading system I'm trying to introduce is also not complicated. And by the way, there's a lot of other things I do other than just this. Okay, so I'm looking across the markets, I'm looking across multiple indexes, I'm looking at time in relationship to price, I'm looking at floor ceilings like this blue line here is also a floor ceiling, this up here is also a floor ceiling. So, you know, you cannot, let me say this, guys, you cannot trade Elliott by itself and expect to make money. In and of itself, Elliott Wave is not a trading system. You will get yourself hurt, you will lose money. You have to layer in other things on top of Elliott Wave for it to be productive for you. It's a pattern recognition system, and it helps you see support and resistance. As I said at the very beginning, that's what you need, is some sort of way of understanding you know, support and resistance, whether you do Fibonacci patterns like Gartley's and Shark patterns, or if you use Elliott, or if you use classical like Jack does. You need to have a system like that to help you see patterns. And
actually, the truth is that any method in isolation is likely to be less good at calling the market and letting you see where the next turn is going to be. You know, for instance, I mean, a decent understanding of Fibonacci's will help you on almost any method. On classical charting, you know, you're seeing one side, you'll miss others. The reality is, if you can combine various different RSI, obviously, Stan and I put a huge amount of work into, just because it's such an enormously useful indicator. You need different things, and you need different things to converge together to give you your best plays. And it's anyone who tells you that you know, there's a simple trick to identifying market moves, it's just garbage.
Yeah, right, there is nothing simple, guys. Well, let's put it this way. You can try to keep it simple, which I do. I use RSI a lot. I use floor ceilings a lot. I use Elliott a lot. I use Fibonacci's a lot, and that's my main thing. And then I use correlations. So, you know, you can keep it simple, and I'd encourage you to do so. If you have like 8 indicators and you're looking at like 3 of them that are doing the same thing, like for example, what's the difference between MACD and RSI? Well, not a lot, to be honest. The divergence on a MACD is going to look like the divergence on RSI, so why would I use MACD? I need just one indicator to show me that, you know. So anyway, other questions here, Jack. I'm just going to try to get to these. Okay, so I showed a flat. I shared the example of a flat, right? Okay. Coffee, David, I might take a quick look at coffee here in a moment. I shared the difference. I talked about WXYXZ and traditional fibs. Can you say something about pattern and market psychology? Fred, I'm not sure I understand what you mean about pattern psychology. Or Jack, do you have a perspective on that question? I'm not sure I'm clear about it. Can you say something about pattern?
Yes, I do have a perspective. I don't understand it either. We need a bit more clarity as to what exactly he means.
Yeah, okay, Fred, if you can clarify that, I'm happy to try to answer the question. How far do you wait after a higher low to determine that is valid and not noise? In terms of it not being noise. So Ken, let's just take an example. Okay, so any impulse that you have off of a bottom, especially a very strong impulse like this, even the dollar that we just had, I could go to the dollar chart. It reminds me of the you know, this sort of move where you get a really spiky move and then you get this big move up, right? Any back test here, 50% or greater is a higher low in my book. And so what you're doing is you're putting on risk and you're putting your stop below the low. And you wait until you get into an area where you feel comfortable with that. So, you know, maybe I wait until it's 50 back, and maybe that's right about here, and let's call that 36, 37. And my low is at 30, so I'm putting on 6, 7 handles of risk there, and I'm comfortable with that. And what I will do is size the trade appropriately so that if I lose 7 handles or 6 handles, I'm not losing my whole account. Okay, so I think a lot of guys, what they do when it comes to trading is they put on too much risk. So I know a guy, he started trading, his first trade was 80% of his account. And you know what? The worst thing that could have happened to him was it worked. He got lucky, it worked. He thought, oh, isn't this easy? And of course, a few weeks later, he blew up his whole account. Okay?
Yeah,
so,
famous lost words.
Oh, yeah. So, you know, I very seldom have 20% risk on, guys. I make a trade, I'm in, maybe 10, 15% or something like that. A 10% is a nice, comfortable position for me. I don't sweat at all. I don't worry at all. I sleep very well at night. You know, a real good indicator if you're putting on too much risk is this. You're not sleeping at night, okay? It ain't worth it. It ain't worth it. Trust me. I've been there. I've done that. I won't ever do it again. I love trading, so I'm very happy putting on 10% size and sleeping at night and getting lots of base hits. I think trading is about base hits, not home runs. All right. Where do you put risk at the X, Sebastian? Where do you put risk at your 57? Okay, let's find 57. I think you're talking about this one here. So risk for me would be the trend line. Okay, so in any trend, whenever I'm in a trend, the reason they call it a trend line is because it's a demarcation point for the trend. Okay, so if I'm getting on here and my marker is this is a flat, and we called this as a flat on this day, which was Monday, I believe, this week, I said this is a flat. Here we are. It's 1.618, perfect. And by the way, go to the other indexes on this day. They're also flats. They're a bunch. I remember doing the analysis. There are a bunch of them. They're all flats, and I'm thinking to myself, God, this is a reversal pattern, right? And it's kind of scary, isn't it? Because here is this huge move, right? It's a bear market type rally, which, first of all, if you can see that, it helps you, take risk. But, you put the risk on, and I use trend lines a lot. If I'm near a trend line, that's where I put my stop. Okay, so my stop is up here at 63s, 64s, and I'm getting in at 57s or 56s, whatever. So again, 6-7 handles of risk for me is okay as long as I size it correctly. Now you have to look at risk reward. I'm looking at this as being a W. I'm looking at this being an X, and I'm looking for 24s. So I'm risking 6 to make what? 20. What is that? 33. So, risk reward. It's a great risk reward, and you always look for the extremes. And that's the thing about this is, this was an extreme, okay? And so, by the way, this is the sort of move when the market's doing this, guys. You wait till the end of the day. I think a lot of you know that trendy days. They end near the high or near the low. You wait for the end of the day, and then you put some risk on. Okay, let's.
Because the trend turns into a pumpkin at the end of RTH.
Yeah.
I've got a very good example of a trend line. The trade actually. If you want to throw me the screen back.
Yeah, sure. Happy to. I'll try to organize some questions, Jack, while you're doing that. It helps me.
All right. If we could find out what Fred meant, I'm sure there's a good question there. It's just we don't know what it is yet.
Okay.
All right. Okay, this is the DX chart. Now, I did this last night, so we do a lot of charts on some Wednesdays, but did this last night, and what I was looking at here was this rising wedge. And what I said was, obviously, we'd gone up. Hang on a second. Hang on, I'm on the wrong. Dropbox hasn't updated. Okay, right. Well, it's still the same rising wedge. This isn't actually last night's chart. So on here, we had actually reached this trend line here at 95.2, which is the target we've been looking at. And I was considering what would happen if we went beyond it. And this wedge ended up here by this stage, and pricing is at 95.45. So I say if it goes beyond this level here, which is obviously, as you can see, pretty impressive resistance, but if it goes beyond that, then wedge resistance is currently in the 95.45 area, and I'd be looking for resistance there. Now I'm chatting Stan this morning before the open and saying, and he's I think. Yeah, and Paul's mentioned 95.52, and I've mentioned my 95.45, which is now by that stage 95.48 or 95.5, and it is at that trend line. So this trend line's up at 95.48 approximately, and it's at the trend line. That is a perfect place to put on a trade. So I shorted it, and I shorted it against that trend line. So
yeah, trend lines are great. Trend lines are absolutely great.
But this is a nice trend line. You got 1, 2, 3. It's solid. Yeah, this is relatively mature. It's not in the very early stages of a trend. Of course, nothing's going to last. But the thing is, by the time you've formed what is in effect, a bear flag, and it's a relatively mature pattern, these are trend lines you can depend on. I mean, with a wedge, it might overthrow slightly, but you bear that in mind too. It's but basically, where you want to be shorting on something like that, you want to be shorting at trendline resistance and going long at trendline support, if you possibly can. All right?
Yep, very good. Fred does have a question, and he clarified it very well. Thank you, Fred. What he says here, Jack, is, can't say I know what I'm asking, but I guess it's a general question about why these three-wave patterns form from crowd psychology perspective. Does it come down to support resistance or impulse exhaustion? I'll give you my answer, Fred. I think the reason it works, it's no longer crowd psychology. I think it's machine psychology, if there is such a thing. Okay, and frankly, I think that I always try to find things that work in the market through observation, because like for example, the 200-day moving, 200-day exponential moving average, the 100-week moving average, the 50-day simple moving average. There are certain things in the market that people just have a lot of eyes for. Okay, the weekly pivot. People who are subscribers, how much we use the weekly pivot. We use it a lot. Okay, and that's the pink line on my chart. And so you use what works because there are lots of eyes on it, or in today's modern age, there are lots of machines looking at it, okay? So a three-wave move is very easy for a machine to see, okay? And so, and crowd psychology has a lot to do with flats. I think, in a bear market sort of thing, bear market rallies, look for a flat formation, okay? I always look for it because it's very, very common, okay? And so, and I just showed you a few of those, so that's my answer to the question, Jack. I don't know if you have a perspective on that.
All right. I do have a perspective on that. Is that people ask why too often. Why do fish swim? If you're fishing, it doesn't really matter why the fish swim. That they swim and where they are. Those are the important questions. Why it swims, well, you might be right, you might be wrong, and who really cares? So I think, there's an awful lot of, why does this happen, why does that happen? And actually the classic example I'd use was when I was trying and failing to persuade people that bonds were going to be starting a huge rally at the start of 2014, at the end of 2013, and everybody knew. And there was this wonderful explanation of why bonds were definitely going to go down. And it was just total crap. But the thing is, it sounded great, and it sounded enormously logical. And that is part of the danger of asking those questions. Sometimes you'll get some great answers which are just total rubbish. As it is in this instance, there was the protection. You could have looked back and looked at what happened last time and the time before, and no one did that for some reason. But I think rather than ask why, you're better off actually just doing that to start off with.
Yeah. I just want to go back to things repeating, Jack. Just a minute ago, you mentioned that. Yep. Throw me the screen. I just want to show the daily chart here shortly or briefly. I think some of you may already be aware of this, but the thing that you have to look for, and Jack is right. I would pay more attention to patterns that repeat versus like, for example, what a lot of people were talking about was, oh, we could be going to 2090, the bears could be dead, and all that kind of stuff. Don't get caught up in the Twitter bullshit, okay, as far as I'm concerned. A lot of it is exactly that. Look at this market, okay, look at this market. Before we saw this downturn, what did we see? We saw compression right here. Look at the compression, right? Patterns that repeat. Look here, compression again before the downturn. What are we getting here, guys? What do you see? Compression, okay? We're getting a bit of a triangle. We got plenty of room here for downside action with RSI, with this RSI price cycle that we use, right? We should stay below this trend line and continue lower. So, Jack and I are both bearish, and we're looking at the day-to-day sort of where is support and resistance, et cetera, and so on and so forth. So I just wanted to point that out, Jack, because I think you're better off not listening to what's happening out there in terms of what people's commentary is, like for example, and sticking to, okay, what do I see in the chart? Okay, here's the pattern the S&P has had on the last two turns. Okay, it's compression before the move, and guys, I'm telling you, this compression right here on the S&P, look at the compression right here. We are fixing to make a move here. It's coming, okay? This is going to expand, and it could go either way. I'm not saying it's going to only be bearish, but my lean is certainly that way. But,
and it
you know.
could be up. The setup is down, most definitely, but it could go up. And you've always got to be prepared for the possibility. Because you cannot stand there saying, it will go down if I wait long enough. Because actually, it won't. If it goes the other way, it just...
Okay. Next question. Would you trade SPY the same way as ES? And Jack, what's your perspective on that? I'm going to switch to...
No, because you can't trade a stock like future.
Yeah, I agree with that.
We're mainly focused on futures trading, obviously. I mean, the thing is, no, I mean, you can trade the same things in terms of the price levels and the Fibonacci's and so on and so forth. But in terms of the actual mechanics of how you trade, no, it's very different, obviously. The hours in which you can trade is different. The way in which you trade is different. The risk profile is entirely different.
Yep.
It's different.
Yeah, I think I like futures better because as the market evolves, I can actually make moves after hours, and what used to frustrate me a lot, I still use options for larger swings, but you know, being in an options trade in a stock these days, God almighty, it's just killer when you're trapped long or short. It really is, in my opinion. So, you know, I think futures are actually less riskier than
I think managed properly, I think a lot less, and you don't have that very long nervous pause when you can't deal in it, and you're having to watch markets in which you can deal, in which you could be taking some action, but you can't because you're trading something that can only be traded in RTH.
Yep.
So,
Ken, to answer your question, I use Trade Navigator for technical analysis. This is not what I trade off of. Okay, so this is my technical analysis system. I actually trade off of different software. The next question is there a trick to determining the ABC of a three-wave move while it is happening? Yeah, there is. You have to be, well, you can draw, you know, fibs as the market unfolds. So, you know, I wait for an impulse, okay, like this move here. Let's just take this move here, and I'm looking for three waves up, right? Three waves up, if you look here, ended here, okay? We went right through that area, so that told me it wasn't a three-wave up move, and I went to the 618, and here it is, okay? And then it evolved more, and it turned into 5, and actually we were here that evening when I said we're looking at downside. This is a flat, you know. I think as the market evolves, you have to have very, very good instincts as to where you are in the overall pattern. Like, for example, Sunday, I said, where were we Sunday, Jack? I'm trying to remember. Were we here, I think? Is that Sunday?
we weren't doing a chart on Sunday. We did that on Monday morning.
But we were short. We were short this 100% fib, and I think on Sunday I said we're short the 100% fib. I forget which fib it was, but we were short, and I'm like, you know, maybe it was this one right here. We were short this fib, and I'm like, look, when we don't go to 100% fib, that's a sign that we're in a triangle, okay? And so watch for.
We were talking about that.
So you learn through trial and error to start seeing things evolve as they're happening, and so, for example, if we had come back 50%, then I would have been expecting more upside, okay? If we break through 618 and we get down here to like a double bottom type setup, I'm looking for a triangle, okay? And it's playing out. It did play out, in my opinion. So I think that comes with experience and actually, you know, trading the market, and I think it helps when you're not looking at a 5-minute chart either. I think that
actually just by way of illustration, throw me back the chart. I'll just show them the 1-minute chart I was using today.
Yeah,
and this is a managing stuff on the fly chart.
Yep,
so
right.
It doesn't actually tell you anything about the Elliott Wave structure, but it does. But it is obviously looking at the rest of the structure and the trendline structure. Yep. This is the 1-minute chart I used today. This is yesterday. This is today. And what was I doing with this? When we reached this point today, I was calling that we were hitting declining resistance from yesterday's high, and this hit confirmed this was a falling wedge. As soon as we were breaking up out of it, I was drawing the Fibonacci's. Very easy. Take it from the top, take it to the bottom, This gives you your range. If we were doing a retracement rather than a Fibonacci retracement rather than a full retracement back to the top of the wedge, which I thought was pretty unlikely, and I still do, then we were looking at this range here. We're looking at 38, 50, and 61. As you can see, we came up slightly short of the 50, which I think we're probably going to hit overnight. What are we forming here? Well, I have a perfect channel. This is a classic bear flag setup. Inverted head, inverted shoulders. I called this on the Twitter feed. I called that we had made the target on the SPX IHS, and therefore to disregard the slightly higher ES target. So this is all done on the fly. Yep. Now the trick with technical analysis, I would think, is to try and do at the time, to work out at the time or beforehand what will be obvious afterwards. And you can do a lot of that on the fly. But I mean, you can, and a lot of these things, you can draw the Fibonacci. As soon as you get a setup crystallized by like a break of this trend line here, then you've got the Fibonacci's.
Yep, right.
You can draw those and use them. It's you can, yes. Can you do it without running your own charts? No. You do need to run your own charts, and strongly recommend that anyone who trades does so.
Yep, I agree with that. There's one other thing I want to share, and there's one other question, Jack, but I forgot to talk about 7 swings, okay? And you just reminded me, because if you look at that uptrend, you have 7 swings, okay? So let me share a quick chart.
I'll throw you back a chart.
Yeah, just for a second. I got one more thing in terms of, now many of you who are subscribers, you see me count swings, and I'll say, look, this is at the end, 1, 2, 3, 4, 5, 6, 7, and I'll count 7 swings, okay? I want you to look at this sequence, okay? 1, 2, 3, 4, 5, 6, 7. And by the way, if that were a back test, okay, you can count ABC as 3, right? An X wave as 4, and then an ABC as 3 more. So that's 7 swings. So the amount of times I see a market in a 7-swing move, it is it's more than 50%. Okay, more like 60 to 70% of the time you'll see 1, 2, 3, 4, 5, 6, 7. So it's a very easy way when you're day trading to look at a short-term chart and say, okay, how many swings do I have? I'm at 4, so I'm expecting a 5, 6, 7. Okay, and I used to trade that way. And I used to day trade a lot, and I still do at times, but and I usually day trade around my swing position. So, you know, little tricks like that help save a lot of time in terms of recognizing structure as well. So I just wanted to mention that in terms of counting swings. Sebastian, I use 1 hour and 4 hour RSI, 4 hour for larger swings, 1 hour for shorter swings in terms of ending impulses. Okay, so looking at divergence, and that's an RSI 14. Jack, Sebastian asked, what are you looking for with divergence in terms of time frames that you prefer? And is it RSI 14 or 5?
If we're looking at intraday, then I use the RSI 14 mostly. Not always, but I mean, I use the RSI 5 as less first signals, as more a very short term, might see a bit of a bounce here, or decline here. Yeah, I think the 1 and 5 minutes is what I use, but you will notice that I will use some other time frames. For instance, I was calling a succession of 60-minute buy and sell signals at the start of a day over the last few days, because we've had a few of those and they've been tending to deliver. So I will use that, and I will keep an eye on the higher time frames. But it very much depends on what sort of move you're looking at. I mean, for instance, for the move down to 1965 that we're expecting, I'm really mainly just looking at the daily RSIs and the RSI 5 and 14. Yeah. For stuff like that chart I was showing you today, that's all of that essentially was on the 1 minute chart RSI 14.
Yep. I think it depends upon, it depends upon your hold time. Like if you're a daily chart trader, absolutely, daily RSI is going to deliver much bigger swings than a 1 hour chart, for example. So it depends upon your time frame. I think more
but
than
if you're trading intraday swings, the 1 minute RSI divergences will give you a very large proportion of the intraday swings.
Yep, I agree with that. I agree with that. I like the 1 and the 3 minute for day trading.
Yeah.
with a 3200 tick right next to it, just to have context.
Yep.
I think we're out of questions, and actually that's an hour, which is our normal time, Jack. So I think that's a wrap.
All right, great.
And thanks very much, everybody, for your questions. Great webinar. And Jack, thank you. Enjoyed it.
Pleasure as always, mate.
Yep, same here. Take care. Bye-bye.
Take care, sir.